Vanakkam. In this revision video, we will be quickly revising the important provisions of Ind AS 1 and we will also discuss the study material questions. So, Ind AS 1, as we all know, is mainly a presentation based standard. So, it prescribes a presentation basis for general purpose financial statements. What are general purpose financial statements? That meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular information needs. Now, a shareholder cannot tell the company, you give me a report in this format, right? But a bank can tell that company, bank who is giving loan to that company can say, you give me this projection, you give me your income statement for the last 3 years, 5 years, whatever, and the company has to comply. So, general purpose financial statements are those that are prepared for general use, for users who are not going to ask for specific information, right? So, coming back, the standard also clarifies that it does not apply to the structure and content of condensed interim financial statements, because there is a separate standard for that, Ind AS 34. Some provisions of Ind AS 1 apply to interim financial statements, that is para 15 to 35, relating to true and fair view and so on, right? And if it's a not-for-profit entity, then it can slightly change the terminology. Similarly, entity whose share capital is not equity, they can also change the presentation terms. So, accounting policy definition is the same as in Ind AS 8. What is the definition? Specific principles, bases, conventions, rules and practices applied by an entity in preparing and presenting financial statements. So, we all know what is materiality. So, materiality, information is material if omitting, misstating or obscuring could reasonably be expected to influence decisions that the primary users of general purpose financial statements make. And we all know that this depends on the nature of information, magnitude of information, and it can be material in combination even if it is not material individually, right? And who are these primary users? They are basically existing and potential investors, lenders and other creditors who cannot require reporting entities to provide information directly to them, right? So, if the decision of the primary user is going to be affected by the omission, misstatement or obscuring, then that information is considered material. Total comprehensive income, we know, is the change in equity basically, and it has two components. One component is profit or loss and the other component is other comprehensive income. So, profit or loss plus other comprehensive income is total comprehensive income. Next, we come to complete set of financial statements as per para 10. So, it is balance sheet at the end of the period, statement of profit and loss for the period, statement of changes in equity for the period, statement of cash flows for the period, notes comprising material accounting policy information and other explanatory information. Before, this used to be significant accounting policies. In 2023, this was changed, and comparative information, that is previous year figures, balance sheet at the beginning of the preceding period when an accounting policy is applied retrospectively or there is a retrospective restatement or when it reclassifies items. And there is a qualification given in para 40A that this third balance sheet is required only when, in addition to the retrospective application of the accounting policy, retrospective restatement or reclassification, that affects materially the balance sheet at the beginning of the previous period. So, if you are talking of 31/3/2026, in that year you make a retrospective restatement, let us say. So, it should affect the financial position at the beginning of the preceding period. So, current period is 1/4/25 to 31/3/26. Previous period will be 1/4/24 to 31/3/25. So 31/3/26 year ending, if you make a retrospective application of accounting policy or restatement or reclassification, and it affects the financial position on 1/4/2024, then only third balance sheet is required. So 31/3/26, 31/3/25 and 1/4/24 if it affects the position on 1/4/24 materially, otherwise it is not required. So this complete set can be summarized like this: balance sheet, statement of P&L, statement of changes in equity, statement of cash flows. So all this will be for end of the period or for the period, as well as for the previous period, comparative information. In addition, mandatorily we are required to prepare a third balance sheet at the beginning of the preceding period. If there is retrospective application of accounting policy, retrospective restatement or retrospective or reclassification that has a material effect on that balance sheet, then only that balance sheet is required. Apart from that, we need to give notes and comparative information, that is preceding period information. So suppose we present all this and we want to present a third statement of P&L also. Is that allowed? Right? Or third statement of changes in equity or another statement of cash flows. Are we allowed to do that? Yes, that is definitely allowed. That is as per para 38C. Of course, you don't need to remember the paragraphs, it's just for reference. So whenever you present additional comparative information, it doesn't mean you have to present a full set. You can choose to present only a third statement of P&L. Okay, that doesn't mean you have to definitely present third balance sheet or third statement of cash flows or third statement of changes in equity, right? So coming back, a complete set of financial statement comprises balance sheet at the end of the period, P&L, changes in equity, cash flows for the period with comparative information. So the two statements each, then notes, and then balance sheet at the beginning of the preceding period in certain specific circumstances. Apart from that, you can present any of these statements as a third statement additionally, right? So moving on, so P&L is a single P&L with two parts, profit or loss and OCI, unlike in IFRS where they are presented as separate statements. So if there are additional statements which are not financial statements like financial reviews, then they are not within the scope of Ind AS, right? Next, financial statements should present a true and fair view. That means they should be in accordance with the definitions and recognition criteria for assets, liabilities, income and expenses set out in the conceptual framework. So application of Ind AS along with necessary disclosures is presumed to result in true and fair view. So if you have followed Ind AS and if you have given the correct disclosures, it is presumed that the financial statements give a true and fair view. Here the terminology is slightly different from IFRS where faithful presentation is used. In Ind AS it is true and fair view. So once you comply with Ind AS, you are required to make an explicit and unreserved statement of compliance. That means you have to say that you are complying with Ind AS. So this statement should be made only if you are complying with all the requirements of the applicable Ind AS. Now this again depends on whose opinion, on the company's opinion or auditor's opinion. Company may think we have followed Ind AS and we want to make the explicit and unreserved statement of compliance, but the auditor may have a difference of opinion. No, you have not followed. So should we or can we still give this explicit and unreserved statement of compliance? Yes. So this is dependent on the opinion of the management, not the auditor. Okay. So this requirement is being given for the management who prepares the financial statements, right? So this concept is there in illustration 1. Entity prepares its financial statements that contain explicit and unreserved statement of compliance. but the auditor's report contains a qualification because of disagreement on application of one accounting standard. In such a case, is it acceptable for the entity to make an explicit and unreserved statement of compliance? What is the answer? Yes, because that is not dependent on the auditor's report. So, whether in your opinion you have applied accounting standards or not, that depends on the management, not on the auditor, right? So, in fact, it has to make an explicit and unreserved statement of compliance if it believes that it has followed Ind AS. So, next we come to preparing accounts on going concern basis. So, by default, financial statement should be prepared on going concern basis unless there is an intention to liquidate the entity, cease trading, or there is no realistic alternative except to do the above. So, if any of these situations are there, then we do not prepare on going concern basis, and then we disclose that fact along with the basis on which we have prepared financial statements and reason why it is not regarded as a going concern. If we are preparing on going concern basis, but we feel that there are some material uncertainties relating to events or conditions that may cause significant doubt on the entity's ability to continue as a going concern, then we disclose those uncertainties. This paragraph can be expressed in the form of a chart. So, the general rule is we prepare on going concern basis. If there is an intention to liquidate the entity, then we do not prepare on going concern basis, and then we will disclose the fact that it is not prepared on going concern basis, the actual basis on which financial statements are prepared, for example, net realizable value basis, and the reason why it is not a going concern. If there is no intention to liquidate the entity, then we check whether there is an intention to cease trading. If there is an intention to cease trading, then the same points we do not prepare and we disclose. If there is no intention to liquidate, no intention to cease trading, and then we check whether there is any realistic alternative. So, we may not have an intention, but we may be forced to do it, right? We may not want to stop our trading, but we may be forced to do it. So, if there is no realistic alternative, we are forced to either liquidate or cease trading, then also we cannot prepare on going concern basis and we have to make the necessary disclosures. But if there is no intention to liquidate, no intention to cease trading, nothing is forcing us to either liquidate or cease trading, right? We have alternatives. So, if we do have realistic alternatives, that is if the answer is yes, then we will prepare on going concern basis, right? Even if the answer is yes, we may have some material uncertainties relating to events or conditions that may cause significant doubt upon the entity's ability to continue as a going concern. Basically, today it is a going concern, but there are some uncertainties. It may not be going concern in the future. If that is the case, then what to do? Then we will prepare on going concern for the current year, but we will just disclose those uncertainties. So, that was para 25. Now, coming to the next paragraph. So, we need to consider all available information about the future, which is at least but not limited to 12 months from the end of the reporting period. So, what is going concern? Whether we can continue in perpetuity. So, if say a government notification has come, right, that 1 year from now they are going to impose certain kind of taxes, right, and that may affect us. So, that may affect our ability to continue as a going concern. So, we consider such information also when determining whether the going concern assumption is appropriate. So, there is a time restriction for that. So, whatever information affects the future, it should be at least but not limited to 12 months. That means there is a mandate given to the management. Don't just take the current information, take also the information which is going to affect the future, at least 12 months. Okay. So, some decision, some notification may affect 2 years from now, that also we can consider, but compulsorily we have to consider information for at least 12 months, right? Let's now do illustration 2 from the study material. So in this illustration, there is a company XYZ, which is a manufacturer of plastic products. On 1st April 2016, the government abolished all import tariffs, which were 40%. And then the currency also started appreciating, making the imports cheaper. So because the imports became cheaper, this company, which was profitable, went into a loss. And then it undertook some restructuring operations, but still, though it managed to reduce the loss, at the end of the year it was still in loss. So 15th March 2017, before the end of the year, the government announced that it will reintroduce 10% import tariffs, and also predicted that the exchange rate will result in a weakening of the jurisdiction's currency. So XYZ, they undertook a going concern assessment on 31st March 2017, and then they concluded that this expected reimposition of 10% tariff and weakening of the currency would result in this company returning to profitability. So how should they disclose the information? So here we need to consider not only current information, but information relating to the future period for at least 12 months. So we know that the government has announced, and it's very likely that the import tariffs will be reintroduced. So we consider that also in the going concern assumption. So if we did not consider this, then maybe the conclusion will be the going concern assumption is not relevant. But because the standard asks us to consider future information also, we consider this expected reimposition of tariff and also the expected weakening of the currency. So we all know when the currency appreciates, that means what, rupee becomes stronger, you pay less rupee per unit of foreign currency, imports become cheaper. We are expecting it to weaken. So when it weakens, that means you have to pay more rupee per unit of foreign currency. That means imports will become costlier. So for this company, if imports become costlier, it's advantageous for this entity, right? So how should the management disclose the information? So now look at your chart on the top right corner. So first the management has to check whether there is an intention to liquidate. That is definitely not there. Intention to cease trading, that is also not there. Is there any realistic alternative other than liquidation or stopping trading? In other words, is there something forcing the management to liquidate or stop trading? No. Okay, there are alternatives. It can continue, right? So going concern assumption is relevant, but this is a material uncertainty. What if this tariff is not reintroduced or the currency does not weaken? Then the going concern assumption may not be relevant. So as of today, going concern assumption is relevant, but there are material uncertainties which will be disclosed. So let's discuss materiality and aggregation as per para 29. What do we mean by aggregation? When can we group items together and need not present separately? So material items need to be disclosed separately, either as separate line items in the financial statements or in the notes to accounts. Immaterial items, that is items that are not material, this of course will vary from entity to entity. Then general rule is they can be aggregated, need not be presented separately. So we analyze this further. If an immaterial item is similar in nature or function, then it can be aggregated. Similar in nature means raw materials or WIP or finished goods or depreciation or finance cost and so on. So that is how we classify in the schedule 3 P&L. So if they are similar, then they can be aggregated. If they are similar based on function, that is factory cost, cost of production, cost of goods available for sale, cost of goods sold and so on, then also they can be aggregated. Please note that grouping based on function is not allowed in Ind AS, it is allowed only as per IFRS. So if an item is not material and it is dissimilar, right? Then we need to check whether separate disclosure is required by law. If yes, we have to disclose separately, otherwise it can be aggregated. So basically material items always need to be disclosed separately. Immaterial items, if they are similar, they can be aggregated. If they are dissimilar also, they can be aggregated unless they are required by law to be disclosed separately, right? So let's now look at the provisions relating to offsetting. Offsetting of assets and liabilities, incomes and expenses are not allowed, but if they are required or permitted by an Ind AS, then they are allowed. So if an Ind AS specifically asks us to offset an asset and a liability or an income and expense, then it's allowed. Offsetting may reflect the substance of the transaction, then also it's allowed. For example, in the case of a commission agent, his gross is not collections from customers, right? So his gross is only the commission, that is collections minus remittances to head office. There commission, which is the net, actually reflects the substance of the transaction. So in such cases it is allowed. Measuring assets net of valuation allowances. For example, fixed assets, property, plant and equipment minus provision for depreciation, or doubtful debts minus debtors minus provision for doubtful debts. These are not considered as offsetting, okay? And you may have gains and losses arising from a group of similar transactions which may not be material. For example, foreign exchange losses and gains arising from financial instruments held for trading. So if it is not material, then it can be offset, but if material, they have to be shown separately, right? So next is illustration 3 from the study material. So there is a company which is acting as a sub-agent and it receives commission and then pays commission to the sub-agents. So now commission itself is a net transaction, in the sense you receive gross from the customers, you remit to the head office, balance is a net amount which is your commission. So for a commission agent, can he show commission as revenue? Obviously yes, because that is the substance of his transaction. But this commission agent also has sub-agents and he is paying commission to them. Can he net both commission received from head office and commission paid to sub-agents? That obviously does not reflect the substance of a single transaction, right? They are two different transactions. They have to be presented separately only. They cannot be offset, right? Now let's do the question 5C, which was asked in the November 2024 CA final exam. So here they have asked us to define offsetting and also whether it's permitted in the following cases. So a definition, you will write what we just discussed, and then profit on sale of asset against loss on sale of another asset. Can it be offset? Generally the answer is no, right? Because they do not reflect substance of a transaction. So if they are not material, because it's a group of similar transactions, then it may be permitted. Otherwise we don't offset. Then expenses incurred by holding company on behalf of subsidiary and receiving reimbursement from the subsidiary. This generally can be offset because it's not the holding company's expense. You are just incurring it on behalf of another company, right? And the last they have asked is whether services are rendered and received from the same entity, whether payable and receivable can be offset. So generally no, but as per Ind AS 32, if the receivable and payable, if the company has the right, legally enforceable right to set them off, and then intends to settle on net basis or simultaneously realize the asset and pay the liability, then it shall be offset. So the slide that we saw, we use the second point. If it is required or permitted by an Ind AS, then offsetting is allowed. So as per Ind AS 32, offsetting of payable and receivable is allowed, and there is a legally enforceable right, and either there is an intention to settle on net basis or both receivable and payable are received and settled simultaneously, then it is allowed by Ind AS 32. So in such cases you can offset. Next, let us come to change in accounting policy, retrospective restatement or reclassification. So if this affects the balance sheet of at the beginning of the preceding period, there is a material effect then a third balance sheet should be presented, right? So, two conditions, either retrospective application of accounting policy or retrospective restatement or reclassification, and it has a material effect on the balance sheet at the beginning of the preceding period. Now, let us discuss illustration 4 from the study material. So, retail chain acquired a competitor in March 2011. Okay, remember the year is 11, and it accounted for the business combination under Ind AS 103 at provisional basis in its 31st March 2011 annual financial statements. Business combination accounting was finalized in 11/12. Provisional fair values were updated. So, 31st March 11 provisional basis, next financial year the values were finalized. Okay. So, 31/3/2012 when we prepare the financial statements, we are going to prepare 31/3/12 balance sheet, 31/3/11. Do we require 1/4/10 balance sheet? So, whatever change has happened in 11/12, does it affect the position on 1/4/10? No, because the business combination itself took place only in 31/3/11. 1/4/10 position is not affected. So, does the restatement require opening statement of financial position on 1/4/10? The answer is no. So, next let us look at frequency of reporting. So, we are supposed to present a complete set every year. So, but suppose there is a change in the reporting period and you are supposed to present for a longer or shorter period. So, let us say you are taken over or you take over, and to comply with some laws you are changing your period. Then why you have used a longer or shorter period, and the fact that you can't entirely compare with the previous period, that has to be disclosed. Next let us come to operating cycle. Operating cycle is the time between the acquisition of assets for processing and realization in cash or cash equivalents. So, operating cycle is raw material holding period plus WIP holding period plus finished goods holding period plus debtors collection period, that is operating cycle. Please note that unlike in financial management, we don't reduce creditors payment period, because by definition it is the time between the acquisition of assets for processing and realization in cash. It is not the time the money is locked up in the form of working capital. That is what we require for financial management. The time between acquisition of assets and realization in cash, right? So, creditors payment period is not subtracted, as para 68 specifies date of acquisition of assets to realization, and if the normal operating cycle cannot be identified, then it is assumed to be 12 months. So, now let us go to current non-current. So, definitions are given for current asset and current liability. Assets and liabilities other than this are considered as non-current, right? So, let us see what is current asset. So, when an entity expects to realize the asset or intends to sell or consume it in its normal operating cycle. So, normal operating cycle can be anything, it can be 5 months, 12 months, 15 months. So, if you expect to receive the asset, okay, within 12 months, that is receive the proceeds from the asset, or you intend to sell the asset, or you are going to consume the asset in its normal operating cycle, consumption will apply to inventory, right? Then it is a current asset. Or when you are holding it primarily for the purpose of trading, or you expect to realize within 12 months after the reporting period. Now, there is a slight difference between the first and the third point. First is you are expecting to realize the asset in its normal operating cycle. Third is within 12 months. Okay. If any of these conditions are satisfied, remember it is or. Okay. It is not that all should be satisfied. Any of these are satisfied, or the asset is cash or cash equivalent. So, cash or cash equivalents are generally current unless there are some legal restrictions from being exchanged or used to settle a liability for at least 12 months. So, 12 months or more, there is a restriction, say some government has frozen your assets and won't release it, okay, within 12 months, then that cash or cash equivalent cannot be considered as current, right? So similar definition exists for current liability. So current liability is when an entity expects to settle in its normal operating cycle or holds primarily for the purpose of trading or is due to be settled within 12 months after the reporting period. So that is, you should settle it within 12 months. 31/3 means next year 31/3. Or it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. It is an entity, if the entity has the right to defer payment for at least 12 months, that means it will pay next to next year, then in that case it is not a current liability. If you don't have that right, then it's a current liability, right? So now the question may arise, what if the operating cycle is 15 months? Okay, let's say I hold an inventory for 14 months. Now it is beyond 12 months. Or I have a debtor. Okay, I expect to receive money from the debtor in 14 months. So when that asset is expected to be realized beyond 12 months, can it be considered as current? The answer is yes, if its normal operating cycle is beyond 12 months. Same way for current liability. So assets or liabilities that are part of the normal operating cycle or part of the working capital used for the normal operating cycle, they are current even if realized or settled beyond 12 months. And for other current assets and liabilities, we will apply the 12-month criterion. For example, bank overdraft. Now, bank overdraft is not part of the operating cycle. It is not involved in converting raw material to the finished goods and then again realizing the cash and then repeating the process, buying raw material. So for bank overdraft and other such assets and liabilities, you have to apply the 12-month criterion. So all other assets and liabilities will be classified as non-current, and non-current assets or liabilities may have a current portion. For example, in the case of term loans, so the installment and the interest portion of the say 5-year term loan which is due in the next year, that portion will have to be classified as current. So current assets liabilities include current portion of non-current assets and liabilities. So insofar as the exam is concerned, we follow the following steps. First, we check whether operating cycle is given in the question. If not, we calculate it. Then we check whether an item forms part of the operating cycle. For example, bank overdraft and financial assets may not be part of the operating cycle. So if an item forms part of the operating cycle, that means if the answer is yes, then we will say that it is current if it is expected to be realized in the case of assets or settled in the case of liabilities within the operating cycle period. If an item does not form part of the operating cycle, then we go by the 12-month rule. So in illustration 5, they have given raw material holding period, WAP holding period, finished goods and debtors collection period. We just add everything to calculate the operating cycle. If creditors payment period was given, would we subtract it? No. Why? Because the definition of operating cycle is time between acquisition of assets, not time between payment for acquisition of assets. So if it was payment for acquisition of assets, then we would have to subtract the creditors payment period. So that's why we don't subtract it. In illustration 6, operating cycle is given in the question. So a very straightforward question, we just analyze based on that. In illustration 7, they have given raw material plus WAP plus finished goods holding period as 9 months and debtors collection period as 7 months. So we add both, we get 16 operating cycle. So inventory and trade receivable, if expected to be realized within the 16 months, then it will be current. We'll come back to illustration 8. Let's now do illustration 9. So they have given raw material, WAP, finished goods, debtors. We add everything. We get 14 months. They've also given creditors payment period 12.5. So will we do 14 minus 12.5 to calculate operating cycle? No, operating cycle is 14. So how should all these items be classified? All these are part of the operating cycle. They are all within 14. Therefore, all these items, raw material, WAP, finished goods, debtors, as well as the trade payables will be classified as current. Next, illustration 10 is an interesting question. the entity has two different businesses, real estate and manufacturing. For real estate, operating cycle is 3 to 4 years, manufacturing it is 15 months. So how will you classify? So you'll have to see which business the asset or liability relates to and accordingly apply that particular operating cycle to either 3 to 4 years or 15 months and analyze current or non-current. Illustration 11, we answer it in an if then else kind of a format. Okay. So they have given us three items: electricity deposit, tender deposit, earnest money deposit, GST deposit paid under dispute. So it all depends on expectation, when the entity expects to realize these assets. If it expects to realize these assets within 12 months from the end of the reporting period, then it will classify as current, otherwise it will be non-current. In electricity deposit, generally we don't expect to get it back. So even though we have a legal right, so generally electricity deposit we classify as non-current. The other two, tender deposit, when you apply for a when you participate in an auction or in a tender and you apply, so the money that you pay, if you lose the bid, okay, you get it back. So again it's a question of expectation, when is the bid date and expectation to win or lose, right? Same way GST deposit also, whether you expect to win or lose that particular case and the timeline. So based on that, the entity has to take a call. So in illustration 12, an entity develops tools for its customers and takes 2 years for completion, and it does this as a service. Material is supplied by the customer. It's a job work. And it's receiving the income in advance. So when will the entity realize this income? When it completes the service, that is, develops the tool and hands it over. Generally, the expectation is it will finish it within that 2 years. So the income received in advance is expected to be settled. Income received in advance is a current liability, is expected to be settled. How will it be settled? When we render the service. Within the operating cycle, yes or no? So what is this income received in advance? It is current. Now coming back to illustration 8, this has both a current as well as a non-current element. So basically you have to split the portion that is payable within 12 months from the end of the reporting period, that will be current, balance will be non-current. So there are bonds for 10 lakhs issued on 1st April 2013, and on 1st April each year beginning from the next year, it pays interest and also part of the capital. It is paying 10,000 of the bonds at 10, that means 1/10 each year, right? So 1st April 2013 bonds issued, 1st April 2014, what will it do? It will pay 8% interest on this 10 lakh and it will also pay 1 lakh principal amount. The balance sheet on 31/3/14, what will be there in the liability side? There will be bonds, 10 lakhs. There will also be interest outstanding, 10 lakh into 8%. So interest outstanding, very clear, that is payable within 12 months, current liability. What about the bonds? Out of this 10 lakh, 1 lakh is payable within 12 months. So that is current portion, balance is not current. So we had earlier seen that a liability is a current liability if the entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period. If it has the right, then it is non-current. If it does not have, then it is current. That means if the entity is not able to postpone the settlement of the liability by at least 12 months, if it is not able to postpone, that means it is current. It has to pay immediately, right, within 12 months. So that is the meaning, right? So this principle is further elaborated in para 73. So basically the entity should have the expectation as well as the discretion or the right to refinance or roll over an obligation. That means what? Basically postpone the payment for at least 12 months after the reporting period. Should have the expectation as well as the right. The answer to both is yes, then only we will classify as non-current. If it does not expect to refinance or roll over, or it does not have the right to do the above, then it will be classified as current, right? Let's quickly revise illustration 13. In this illustration, an entity has taken a loan from a bank It is to be repaid within a period of 9 months from the end of the reporting period. So, at this stage, what is it? It is a current liability. But now there is an event that has happened after this. Prior to the end of the reporting period, entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally roll into the new facility which expires after a period of 5 years. So, existing loan is changing into the new loan. Okay, the existing loan is cancelled, new is created. So, it is a refinancing arrangement. Okay, and that arrangement is entered into before the end of the reporting period. So, now how should the loan be classified in the balance sheet of the entity? So, look at the chart on the top right corner of your screen. So, you have expectation as well as the discretion to refinance or roll over. Already it is done, that agreement is done. It is going to be paid after 5 years only. Okay. So, therefore, what is it? It is a non-current liability. And in fact, even from the definition of current liability, this question can be answered. We need not even go to refinance or rollover. Okay, para 73. So, if you look at the definition of current liability, does not have unconditional right to defer settlement beyond 12 months, right? Then only it is current. Now that right is there, so it is non-current. So, next is, will the answer be different if the new facility is agreed upon after the end of the reporting period? Then it becomes potential to refinance. So, that should not be considered while analyzing whether it is current or non-current. We just go by the first statement, that is, we are assuming all this happened after the end of the reporting period, not before the end of the reporting period. That means at the end of the reporting period, this has not happened. We only have this situation, that is, it has to be paid within 9 months. So, what will be your answer? The answer will be current. Then C, will the answer to A be different if existing facility is from one bank, new facility is from another bank? So, then essentially what will happen is the new bank will pay the old bank. That is, it is like you are paying the old bank and getting money from the new bank. So, in that case, actually the existing liability is not getting changed into a new liability or settling the existing liability and then creating a new liability. So, this, how will you classify this existing liability? That will still be current only because it is repayable within 9 months. Answer will be the same for the next subdivision also. New facility is not yet tied up with the existing bank. Entity has the potential to refinance the obligation. So, this is a very important provision that has come many times, right, in the past exams. Next is a similar concept, breach of material provision of a long-term loan arrangement, para 74 and 75. So, many of these long-term loan arrangements may come with some conditions like promoters' contribution, etc. So, suppose as a breach, suppose as per the arrangement, promoters were supposed to bring in so much. The bank has given a loan subject to promoters contributing X amount by X date, and they have not brought in that amount. Okay, that would be a breach. So, because of that breach, as per the terms of the arrangement, does it become payable on demand? You have to see. If it is not going to become payable on demand, then it will continue to be classified as non-current. But if it becomes payable on demand, then we check whether lender has given any grace period. Okay, if lender has given grace period, basically he has condoned the violation. If that is the case, then it continues to be non-current. Or if the lender has agreed after the reporting period before the approval of financial statements not to demand payment. So, either by the end of the reporting period or after the reporting period, but before financial statements are approved, if the lender has condoned the violation, that is, he has he has given a grace period, fine, he has given time to rectify the violation. If that is the case, then we need not classify it as current. So, it is a long-term loan arrangement, by nature it is non-current. We have committed a breach of a material provision. Check the terms of the arrangement, does it become payable on demand? If no, continue as non-current. If yes, check whether the lender has condoned the violation either before the end of the reporting period or after, but before financial statements are signed. If lender has condoned, that is, he has given time to rectify, I will not demand payment, then continue to classify as non-current. Otherwise, the classification has to be changed to current. Let us quickly revise illustration 14. December 2011, entity entered into a loan agreement with the bank. Loans repayable in 3 installments from December 2015. One of the loan covenants is amount equivalent to the loan should be contributed by promoters by 24th March, failing which the loan becomes payable on demand. So 2011 the loan is given, okay, within 3 months, that is 24th March, promoters should contribute, otherwise that long term loan will become a current liability. As on 24th March, entity has not been able to get the promoter's contribution. So there is a breach, and because of that breach, has the loan become payable on demand? Yes, as per the terms. On 25th March, entity approached the bank, obtained a grace period up to 30th June 2012 to get the promoter's contribution. So it has become payable on demand, and is the grace period at least 12 months? No, grace period is only 3 months. So how will we classify? That is on 31st March 2012, that will be current only, because the grace period should be at least 12 months, which that is not the case. Then B, assume in anticipation that it may not be able to get the promoter's contribution. Entity approached the bank and got the compliance date extended to 30th June. That means there is no breach itself. Before committing the breach itself, it has gone to the bank and it has changed the terms of the loan. So in effect, there is no breach. Breach may happen on 30th June, but as on 31st March, the breach has not happened. Okay, breach has not happened. It has not become payable on demand. So how will the loan be classified on 31st March? It will be classified as non-current, right? So next is illustration 15. So here it's substance over form. Okay, one of the basic principles. So there is a holding and subsidiary, and holding has provided loan to the subsidiary. The subsidiary has to repay whenever the holding demands it. So this in substance forms part of the holding company's net investment in the subsidiary actually. Okay, so that is a substance. Okay, it's not actually payable on demand, though legally it is that way. So how will the loan be classified? It will be classified as non-current, right? So in books of OMN Limited, it is non-current asset because it is a loan given. But from the point of view of the subsidiary, does it have the unconditional right to defer payment? It does not have. Whenever holding asks, subsidiary has to give. So subsidiary has to give whenever demanded. So for the subsidiary, it is a current liability only. So there are actually two things in this question. From the point of view of holding, it is an investment that will be non-current, right? Because in substance it forms part of the net investment, and from the point of view of subsidiary, it has to be classified as current because it does not have the unconditional right to defer payment beyond 12 months. But of course, if both expect that it's going to be settled in the near future, then holding also may have to classify as current only. So there is one more question in the study material, that is just the full balance sheet you can go through. So all the best. Namaste.